Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hanf of Pacific Private Money. Our phone number is 888-912-1190. Now, you're going to use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. And that certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. And we also have a special trivia question where the winner is going to receive a $25 restaurant.com coupon that can be used at hundreds of restaurants. Now, we're excited today because this is our first show on KTRB 860 The Answer at 8 p.m. And for those not familiar with our show, we've actually been on the air for 10 years, a lot of those years being recently on KDOW at noon on Saturday. And our format is, imagine a bunch of guys sitting around this time it's just 2 of us, a bunch of guys sitting around a bar having drinks without the drinks, talking business and real estate, and you, the audience, are listening in. And then today's trivia theme is, we figured we'd go toward the female audience for today. It's going to be chick flicks. Okay?
So 10 years we've been doing the show, Edward. Yeah. And, we came up with the name Best of Investing back then, and might have been a little bit of a braggy title. When we first started doing the show, we did have a guy from the equities, stock market expert. Lately, the last few years, we've kind of pivoted more towards real estate because the sponsor of this show, who is Pacific Private Money, based here in the Bay Area with offices in Novato, San Rafael, and Tiburon, we're really in the real estate industry. We're real estate lenders. We also raise capital from investors to make those real estate loans, and their investments are secured by California mortgages. And so without having a stock market guest today, just the 2 of us, we're going to be talking a little bit, introduce the audience to you and I, those who have not listened to our show before. And they've tuned in at 8 o'clock to KTRB to listen to whatever show used to be on here going, wait a minute, where'd that go? So Edward and I, as we said, started the show 10 years ago, but we both have been in real estate in some form or fashion for the bulk of our careers. I've been in real estate for 38 years, but really I've been in real estate for most of my 61 years on this planet, growing up with parents who were real estate developers, and then going to work for their family real estate development company right out of college, and then starting Pacific Private Money as a lender after the market went through a big big hullabaloo in 2007 and 8. Formed Pacific Private Money in 2008. Edward, your background similar. You were a lender for the longest time in real estate, short-term bridge loans, much like
correct.
What you're doing now.
Yeah. Prior to that, because of my degrees, I had an accounting and tax practice, and did a lot of financial consulting, a lot of insurance work, investment work, but fell into the real estate lending side back in 1991 and never looked back.
Yeah. And both of us do a lot of investing in both real estate and real estate debt assets. Between the 2 of us, we're among the larger investors in our own business interests. We have investments in all 4 of our, individually in all 4 of our mortgage investment funds that we offer others. And, because we're entrepreneurs, we're real estate investors. We run a company that employs 27 people in the Bay Area and growing. We're throughout California now. And we're really highly interested, highly involved, and very much in tune with California's real estate market. And I want to even be more specific than that. At Pacific Private Money, we really specialize more in the residential side of the real estate market, less so the commercial side. And given what's happened this year with COVID and how many commercial properties have become distressed, and their ownership has become distressed, and rents are not being paid, restaurants are out of business, I'm actually feeling quite lucky that we focused on the residential side of real estate finance years ago. rather than the commercial side, which a lot of our competitors focus on the commercial side, and it's just it's a very interesting time right now, and we're going to talk about the market. We're going to share with you information gleaned from articles that Edward and I and our team research and read and study on a weekly basis. We've got our ear to the ground, listening to what's happening out there. But one of the things that we can share with you is, we're not just reading the headlines in the local papers, although we do that as well. Although anyone who's listened to the show before will have heard me rail about, some of the headlines that are written in the business sections of the San Francisco Chronicle and some of the other local papers. They don't really reflect accurately, or they're very misleading in terms of what's actually happening. So, I resort to a lot of paid resources by real estate experts and economists to share with you what we've learned and kind of the story behind the story. So I don't feel like I've done a good job in any given show if I'm not sharing a little bit of, behind the scenes. They're saying this, but really what's going on, in our opinion, is that. And
Gotcha.
hopefully we'll cover some of that today here at the Best of Investing. And normally we have 3 or 4 of us, like Edward said, a few guys hanging out in a bar, having drinks without the drinks, sharing news and discourse about what's happening in real estate today. So we're almost done with our first segment here. When we come back, we are going to start sharing with you some real estate news to end this new year.
Very good. Yeah. All right, here's our first trivia question. What is the chick flick called that stars Jennifer Garner with the mental age of a 13-year-old? Right, that's our first trivia question. The first caller with the correct answer is going to win the tanning certificate from Tanbella. And call 888-912-1190. That's our phone number, and leave your information. And if you're the first caller with the correct answer, you're going to win that tanning certificate. Again, which chick flick called that stars Jennifer Garner with the mental age of a 13-year-old? Stay with us. You're listening to the Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to the Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hanf of Pacific Private Money. Our first trivia question was, what is the chick flick called that stars Jennifer Garner with the mental age of a 13-year-old?
So I've seen that movie, but it's either Freaky Friday or 13 Going on 30.
13 Going on 30.
Ah,
right.
Okay. So
Yep.
Did I cheat by giving you 2 answers?
That's right. Yeah, the other one was Lindsay Lohan in Freaky Friday.
Oh, okay, that's right.
Jamie Lee Curtis. That was a good one too. All right, again, this is our first show that is airing on KTRB 860 The Answer. For many years, we were on KDOW and got switched over. Not a problem. We'd like to talk to a new audience. So, Mark, before we get into a whole bunch of articles, kind of explain what Pacific Private Money does, because it's amazing the kind of yields that you are producing for your investor clients that are actually a lot more conservative than people would think, and yet the yields are so high.
So at Pacific Private Money, we serve 2 groups of clients. First and foremost, we are an alternative real estate finance provider lending on real estate in California. So we've got borrower clients and a referral network of mortgage brokers, realtors, and banks who bring us borrower clients, generally because those clients need a fast solution to a real estate issue, whether it's a purchase issue or they ran out of money doing a remodel and they need to refinance or borrow additionally. Maybe it's an estate issue and siblings want to buy each other out. Death, divorce issues come up. There's a lot of reasons why people turn to alternative financing. Sometimes it's just because they're self-employed and they found the banks are very unfriendly when it comes to giving loans to self-employed, especially if you write everything off and don't report a lot of income. They treat you as such. So, so we're in the alternative, formerly called hard money. That's not a term that's really used that much anymore, because hard money brings up the vision of the lender of last resort. doing seconds to people on their homes when they had one foot in financial disaster or bankruptcy. And we don't really do those types of loans. We really focus on transactional distress, not financial distress. And so fast financing, bridge loans, loans to self-employed, ground up construction loans, especially for, we're doing a lot of home construction loans for those lost in the fire. We've got several on our books that are being rebuilt in Santa Rosa right now. Generally speaking, just, fast, reliable financing for people who, for many different reasons, aren't going to get served from the banks. And then on the flip side, our investor network, our investor clients are people who have learned about us over the years, some since the very beginning of 2008 that were associates and people that I knew in real estate who knew back then in 2008, when it was still a fairly closely guarded secret, that you could make some amazing returns investing in private mortgages. And so we've been doing that since 2008. We've originated over 2,000 loans. We're going to crack $1 billion in total loans funded in the next 90 days. And all of that nearly $1 billion of financing spread over 2,000 loans in California, 100% of that has been private capital, private money from individuals like you listening to this show. Most of them are accredited investors, meaning they've got a net worth of $1 million. That's basically by law. But generally speaking, it's been, we've provided returns between, if you use an average, the average is between 8 and 9%. It's a little bit lower today because rates have become more competitive as mortgage rates have gone down. Private money mortgage rates have also gone down. So today's distribution range might be between the mid to high 6s to the mid to low 8s, about a 2% range there, depending on what type of vehicle you're investing in. But today, our many, if not most of our investors are investing not so much in individual notes, but in one of our 4 mortgage pool funds. And the reason for that is it's a more effective way for us to conduct business. We can be more competitive. We can react more quickly. And it also makes us more competitive because a lot of institutional investors have started to come into this field. They've seen these, above market returns that have security, and it's attracted a lot of institutional and New York money is coming into California. And that's, any of you listening who've invested in individual notes over the years have seen fewer note investment opportunities in the last 24 months. And the ones you are seeing are paying lower rates than you're accustomed to seeing. So, but at Pacific Private Money, in those 2,000 loans, we've never lost principal. And in fact, in almost every one of those loans, we've even returned 100% of the promised interest. So we've got a super low foreclosure rate, super low default rate. And it's an amazing investment opportunity that still, even to this day, I think there's a significant portion of the population that doesn't understand what we do and doesn't understand that you can make 7% easily on your money all day long with safety and security features that you're not going to find in the stock market or other investment vehicles that promise a similar return.
Well, basically, you're acting as the bank, plain and simple. Instead of someone going to the bank to get a first mortgage, they're coming to you to get a first mortgage. And investors can take advantage of that and basically be the bank. And their security is the fact that they have a deed of trust, a mortgage against the property at a fairly low conservative loan to value. So the risk is small.
I had visitors yesterday, and we sat in our office with masks and talked about investing. And even still to this day, the most common question I get from a potential investor is, I assume that most of your borrowers have poor credit. Can you explain to me, some of the credit issues they face? And I said, well, first of all, the whole premise of your question is not correct.
Yeah,
Our
exactly.
average
Why would
borrower has
anyone borrow at this kind of rate? We'll get
our
into
average
that in the
borrower
next
is a
segment.
700 credit score, and we often make loans to people with 800 credit scores.
Okay,
So,
we'll get
and
into that in the next segment because
we'll talk a little bit more about the kind of borrowers we serve and why they come to us and not the banks.
All right, here's our second trivia question. What chick flick is about a federal agent who goes undercover at a beauty pageant? Right, call 888-912-1190. The first caller with the correct answer is going to win that tanning certificate. The next trivia question, we're going to give out a restaurant.com $25 certificate. Stay with us. Call 888-912-1190. Be the first one with the correct answer to this question. Which chick flick is about a federal agent who goes undercover at a beauty pageant? Stay with us. The Best of Investing will be right back. Welcome back to the Best of Investing. Edward Brown here along with Mark Hanf. And again, if you're joining us for the first time, imagine a bunch of guys sitting around a bar having drinks without the drinks, talking business and real estate, mostly real estate. You, the audience, are listening in. That's our show, The Best of Investing. We've been on for 10 years now. This is our first show, though, on KTRB. Our trivia question we just asked was, which chick flick is about a federal agent who goes undercover at a beauty contest?
Sandra Bullock.
Yeah, true. What was the name of the show?
I don't know the name.
Miss Congeniality.
Oh, that's
very good, though. I touch on that. That's good. Okay,
Yeah.
so Mark, if we sort of teased the audience a little bit just before we went to break about, effectively how can you pay 7 to 8% to your clients? Obviously a borrower is borrowing at a higher interest rate than that because you've got to make some money. Why would anyone pay that kind of interest unless it was a risky loan?
We charge our borrowers anywhere from the high 7s to the high 9s. That's probably 90% of our loans, especially our first position loans, are going to be in that high 7s to high 9% range, and a couple of points. So when bank rate financing is less than 3%, why would anybody come to us? Well, there are many, many situations when you're trying to buy or refinance real estate where you simply cannot get the bank to make that loan to you. And it's just surprising that how many people don't realize this. If you're self-employed, you know this from experience. No matter how much money you make when you're self-employed, it's just really difficult to get bank financing. And if you're trying to be competitive and compete with cash buyers or buyers that have learned to make offers with low or no contingencies, you're just not going to be able to get a bank to close quickly enough for you if you're self-employed. And self-employed borrowers make up a significant percentage of California because of how many people own their own businesses.
Well, I think speed. Correct me if I'm wrong, but I would think the number one reason would be because a lot of these people, a lot of your borrowers have 700 and 800 FICO scores.
Yeah.
Speed.
Number one is speed. Yeah, if we look at all of the loans we make in a given year, all 200 loans, the number one reason people came to us was urgency. Their bank financing has glitched or has stalled. They're in contract. The seller said, no more extensions. I'm keeping your deposit if you don't close by Friday. We get that panicked call on Monday morning, and we can close, in 5 days or less if we need to. We'd prefer to have a couple of weeks, but we rescue deals. We actually do good work. We're not predatory lenders. We feel bad for people who are in a horrifying position and maybe have hammered credit because they went through something, but that's just really not the loans that we focus on. There are lenders out there that do focus on that. They're the lender you go to when you've got a 500 credit score and you've got a little bit of equity in a piece of property and you want to pull out some money and to cure your financial needs. But really, we're not in that line. We're really in the we have the capital and the capacity to close on a transaction quickly. And so, number one, speed. Number two, they're self-employed. Number three would be maybe the condition of the property or the type of property just doesn't qualify for bank financing. That would include construction loans. And I'll tell you that most banks are just not making construction loans right now. And
here's the funny thing. It's almost like an arbitrage. I mean, you could charge borrowers 4% interest if the clients would be willing to invest with you at 2%. But nobody's willing to invest money at 2%. They want to earn a higher yield, which is why you got to charge what you have to charge.
We charge our borrowers as low as we can, given what we know it's going to take to fund that loan. So depending on our source of capital, whether it's a group of individuals or one of our funds, we know what the cost of capital is, and therefore we mark that up a little bit so we can make a short strip. So we're not, we're kind of agnostic. You're right. I would do 5% loans all day long if I had a cost of capital at 3%. And my loans would all be 12% if my cost of capital were 10%. It's just, exactly. And then it might go up that way again, because you and I both remember the good old days of 12% mortgages.
Yeah, exactly. Now let's, again, we've got a couple of minutes here before we cut to a break. So you have 4 different funds, and there's reasons for different funds.
Yeah, so our legacy fund, which is the first one we started back in 2013, is just a very general private money mortgage pool fund. It has a diversified number of loans, short-term, mid-term, a mid-term loan, and long-term. A long-term loan for us would be like 3 years. So it's called the Pacific Private Money Fund. It has been paying in the high 7s for, ever since its existence. It's paid close to 8% the entire time. It's an unleveraged fund, meaning it's a pure yield. And we share our origination fees with the fund members, so that we're able to maintain around close to an 8% distribution, even though I think some of the loans in that fund are, in the mid 8s to low 9s. Again, that's the Pacific Private Money Fund. 1-year lockup on that, $50,000 minimum investment to open up an account. That's our main fund. We have a $62 million of assets under management in that fund as of December. Our other 3 funds all are very specific niche funds. The second fund is the North Star Capital Fund. That fund makes construction loans. That's 100% construction loans. And that fund has a preferred return of 8 with a target payout of 10. I didn't say the preferred return on the Pacific Private Money Fund is 7. So Pacific Private Money Fund, 7% preferred return, about 7 3/4 distribution this year. The North Star Fund, an 8% pref, makes construction loans, paying out about 10%. The third fund is called the Pacific Southwest Note Fund. That invests in seller carryback notes that we buy at discounts. That one's based in Texas, and that one pays, right now it's paying close to 12%. And last but not least, the Freedom Fund acts like a money market account for the investors, in that we just pay a flat 7% on that, and we use the money to close loans that we're going to sell within 30 days. And so for a recap, go to pacificprivatemoney.com. All 4 of our funds are listed on there, pacificprivatemoney.com.
Okay, we'll get into more of that when we come back from break. Here's our third trivia question. This one's going to be a special one, where the winner, we're going to take the third caller on this one, is going to win a restaurant.com $25 coupon. Which chick flick is about 2 best friends who have known each other since they were 10, and in the end, one of them dies? All right, call 888-912-1190. The third caller with the correct answer is going to win the restaurant.com certificate. Stay with us. The Best of Investing is going to be right back. Welcome back to the Best of Investing. Edward Brown here, along with Mark Hanf of Pacific Private Money. Our third trivia question, the special one for the restaurant.com certificate, $25 coupon. Actually, we're taking the third caller with the correct answer. What chick flick is about 2 best friends who have known each other since they were 10, and in the end, one of them dies?
Sounds like a happy ending there.
Yeah.
Oh my goodness. No, I don't remember that one.
I never actually saw it. Beaches.
Oh, yeah. No,
I think Bette Midler's in that one. Okay. So, Mark, how does it work with your funds? Give us the lowdown. Are there any fees to get in? Is there any holding period? Is there any load coming out, et cetera?
So most mortgage pool funds that we know about have no fees going in or out, and neither do ours. There's no load. You invest, if you invest $50,000 or $100,000, 100% of that money goes to work for you. as soon as it's deployed within the fund. Sometimes there's a lag time of a few weeks, but that's a detail we can get into, when you call us with questions. But all of your money goes to work, and there's no charge to withdraw money either, no load at the end, if you keep your money in for at least 1 year. And that 1 year hold applies to 3 of our funds. But the Freedom Fund that I started to run out of time in our last segment, the Freedom Fund, we do not enforce a lockup or a hold. It's designed for high net worth investors who have cashed out either in real estate or sold a business or took some profits from their stocks, and they're sitting in cash and they don't want it to sit in a checking account earning next to nothing. We pay 7% to rent that money from you, and you can withdraw that money with a 30-day notice. Oftentimes we can pay it back. We can redeem it much quicker, but we ask for a 30-day notice, and we use that money to close real estate loans that we're going to sell immediately to our institutional buyers or to one of our other portfolios. So again, that money turns over pretty quick. But again, no load, no fees. 100% of your money goes to work for you. We're very, very cost efficient in that we have very low expenses in all of our funds. So, and none of our funds currently are leveraged, although a couple of our funds are designed potentially to have leverage down the line. But right now we have 0 leverage on all 4 of our funds. And so we consider them each and every one of them to be in their own right, conservative and, secured by real estate. Which again is something that, when you're investing in today's stock market or you're investing in Bitcoin, both of which are at all-time highs, you have to wonder, are you willing to put your, a portion of your life savings into that, given, the potential for underperformance in the coming years, given that we just don't know which direction the economy is going to go. We don't know if we're finally going to see a natural recession, not necessarily the false recession that COVID created, but there's just a number of unknowns going into the future in that regard. And even real estate, we just don't know if there's going to be much in the way of appreciation in the coming years. But debt is something that we're very bullish on. We think the safety and security features of real estate debt outweigh most other investment opportunities.
Well, yeah, I want to make a point about that too, because, with all of the news out there with Ponzi schemes and that sort of thing, one of the interesting things with the Pacific Private Money Funds is it's an open book, and one can actually go to the recorder's office and double check to make sure that all of the loans that you have in your portfolios have been recorded, because you get title insurance. So there's really no chance for a Ponzi scheme there, because you've actually got the collateral. And it's kind of funny, I've sort of said this sort of tongue in cheek, but on some of these like trillion-dollar mutual funds, and I've asked someone who's really high up in one of those companies, I said, has anybody ever gone to the registrar's office and said, hey, the XYZ fund, they say they own 1 million shares of Facebook. How do I know they own 1 million shares of Facebook? Just because they have a report that says that? You'd actually have to go to the registrar's office and check. I'm not saying that there's any problems with them, but I just think it's kind of funny, because in alternative financing, which is what the Pacific Private Money Funds are categorized, people are a little concerned that, what's backing these assets? How do you just report what you report? Well, okay, check the books. You can actually check with the registrars or the recorder's office.
No, it's true. Again, for more information about our funds, pacificprivatemoney.com, pacificprivatemoney.com, or call us anytime at 415-883-2150. We have a brick and mortar office in Novato, San Rafael, and Tiburon, 415-883-2150. We're happy to meet with you by Zoom, in person with masks, or just talk on the phone and explain more information. Before the show's over, I want to make sure, because we've done a lot of talk about who Pacific Private Money is and what we do and how we provide returns to our investors. I want to share with you one of my favorite economists, Mr. Thornburg, Chris Thornburg at Beacon Economics, just released an update. He's been one of my favorite economists, one of the more well-respected, and he's California focused, which is one of the other reasons I appreciate him. He said, a hard winter ahead, but vaccine news boosts an economic recovery that is and has been already underway. So I know you wouldn't read that in the local papers. It's not telling you that we're in a recovery. In fact, it's just the opposite. It's making it sound like with continued high unemployment in certain areas that we're in a recession and that it may get worse next year. Well, here's an economist that's saying that's just not true. It's just not supported by the statistics or the facts. He says, as one of the most traumatic and disruptive years in U.S. economic history comes to a close, good news on multiple fronts suggests better times are on the not too distant horizon. Despite economic pain from COVID-19, according to the Beacon Economics latest outlook for the US and California and the nation's economy, it's not shattered, has already seen a remarkable bounce in economic activity, and is headed into the new year with a good degree of economic momentum. So they're challenging the doomsday predictions of many forecasters. They are saying that U.S. GDP growth will be 5 to 6% in the fourth quarter of 2020, and 4 to 5% in the first quarter of 2021.
I think a lot of it is people become their ingenuity comes out. I mean, like at Pacific Private Money, you actually had your best quarter last quarter.
Yeah. Another article I thought was interesting, that's not necessarily economic news, but we keep hearing about people moving out of California. Oh, yeah. The city of Austin must be exploding because every time I read an article about somebody moving out of California, they're moving to Austin, Texas. I don't know. I got to go visit Austin, Texas to see what's going on. But the population of California actually goes up every single year, and it's gone up in the last fiscal year ending July 1st, but only went up by 21,000 people. So out of 40 million, that's not very much. Yeah. But essentially what's happening is we do actually have a net loss of migration out of the state. 136,000 people, more people moved out of the state than moved in the last fiscal year. And we had 280,000 deaths. So 136 net loss from migration, from moving, 280,000 deaths. But we had 437,000 births. So that didn't quite zero out. It was actually a plus 21,000 net population gain. Well,
for the unemployment, you got to put those 2-year-olds to work. You know?
Yeah, you do. Rising home prices this year have added $1 trillion to homeowner equity nationwide. Wow. And why is that relevant? Well, you keep hearing people talk about, we got to jump?
Yeah,
okay.
we have to jump off. Tell you what.
I'll wrap up.
Wrap up in the next segment. All right. Stay with us. The Best of Investing. We'll be right back with some closing comments. Welcome back to the Best of Investing one more time. Last time for today, I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money. Mark, before we had to cut you off short, you're talking about there's $1 trillion.
I was talking about the $1 trillion added to homeowners' equity last year. So the reason why this is important is because, there's still a lot of bubble boys out there that are predicting a wave of foreclosures and or a downward trend in real estate next year. And the forecasters that I listen to and pay attention to that I think have credibility, none of them are predicting a wave of foreclosures, nor are they predicting a significant drop in real estate prices in any market in the United States. Why the $1 trillion added to homeowner equity this year is important is because people are less likely to lose their home to foreclosures if they have equity. The reason we had such a huge foreclosure wave in 2008, 9, and 10 is because prices went down so dramatically. The bubble burst because of the money bubble that was created, the credit bubble that was created there. We don't have a credit bubble now. We don't have an equity bubble. And prices are supported by the fact that demand continues to outpace the supply and the supply of new homes that are added to inventory every year. And that's just something that's not predicted to change. The numbers don't bear that changing anytime, at least not in the next year. So, that $1 trillion is good news. It provides an important buffer to protect families if they experience financial difficulties, which a lot of families are right now. Plus, we've got regulations preventing banks and other lenders from foreclosing out consumers from their homes. So these are all reasons why, again, we continue and remain bullish about the residential real estate market in California and throughout America. because you've got supply and demand issues that are continue to maintain the price supports. You've got demand for people, particularly moving into suburbs, and then you've got higher equity as a result that will prevent people from losing their home through a wave of foreclosures.
Very good. For more information again on Pacific Private Money Funds?
.com. Yeah, pacificprivatemoney.com. And we're in the 415. We're at 415-883-2150. And I got one more thing to share with us before we wrap up. Housing economists, there was a Zoom meeting of leading housing related economists recently, and the vast majority of them were predicting prices to continue to increase, housing prices to continue to increase in 2021, though not as rapidly as this year. This year's rapid increase was really caught a lot of people by surprise. And in fact, one economist at the Zoom presentation said he did not anticipate home prices to soar once the economy reopened earlier this year. Was quite a surprise to him, which just goes to tell you that economists don't always get it right. We know that. Yeah. But when you have a preponderance of economists basically saying that home prices look stable and should continue to rise into 2021, and that no one's predicting a widespread of foreclosures, even if unemployment remains high, because of growing equity. So this is similar to the other article I shared. Simply put, even if homeowners are falling behind on mortgages, but if they have, there's still a strong market to sell before they would get foreclosed out. So good news for the
good news all around. Okay, Mark, thank you so much. Again, this is our first show on KTRV 860 The Answer, the best of investing. Here's our thoughts for the day. They say don't try this at home. So Mark, I'm going to come over to your house and try it. And I worked out almost every day. Friday I almost worked out. Saturday I almost worked out. Sunday I almost worked out. I thought you'd like that too. Yeah. All right. Tune in next week to the Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.